Good afternoon. My name is Maurice Crespi. I'm the managing partner of Schindler's Attorneys. Schindler's Attorneys are a co-founder of COBRA being a pro bono initiative that's been set up between IQ Business, Engaged, and Schindler's Attorneys with a whole host of partners. We now have in excess of 30 partners who've all come together with a view to assisting in this time of crisis and this time of need. The idea is that we have our professional skills, abilities made available to businesses on a pro bono basis where needed. So we've put together not only webinars such as today, which was informative on a pro bono basis, but we also schedule one-on-one meetings on a pro bono basis with you or your team to answer specific questions in relation to your industry or your business. We have webinars that deal with business turnaround and the business rescue process on Mondays. We then have targeted webinars such as today's, where we deal with specific issues and we call upon experts for specific insights in relation to matters which are arising in this, the state of flux as a result of COVID. So today we have Singular, who will be presenting. We are fortunate enough to have guests from Milan, Italy, London, and Johannesburg, South Africa. So we have an international panel today. Very, very exciting. I'd like to thank them for joining, and I'd like to thank you for attending today. Please bear in mind that we have these webinars every day, so just look on the COBRA website for additional information. That's www.cobra.org.za. So let me introduce my panel. So Singular is an independent strategy and investment firm with a global footprint. Singular enables its clients long-term strategy development, innovation agenda, and critical investment decisions. Singular's innovative mindset, practical approach guided by first-hand experience and execution focus is the special ingredient of its DNA. So we'll have Lorenzo Toncati, who's a serial entrepreneur and investor. He's been on the show more than once. In fact, I see that our numbers are increasing every time he comes on the show. So we actually have a great audience and a great reception, thanks to Lorenzo and his guests, and also Annalene, who provides brilliant insight. So he's, as I said, he's an entrepreneur. He has, over the years, he's co-founded and still a director of the Singular Group and the Winterberg Group, that are private equity investors. It's a private equity investment firm focused on growth capital in Central Europe. Lorenzo started his career at Bain & Company, and he holds an MBA from the London Business School. Annalene is a manager at Singular. She has a master's in chemical engineering and has spent her career supporting African business in strategy and organizational transformation. And then we're very, very fortunate today to have a special guest who we'd welcome, and hopefully this will be his first but not last time on today's show. It's Ioannis Ioannou. I hope I pronounced that correctly. I did go to a Greek school, but he tells me it's Cypriot, but I think I should be pretty close, hopefully. He's an associate professor of strategy and entrepreneurship at London Business School. Throughout his tenure, he has regularly published in top-tier academic journals and has been cited in the Financial Times, Bloomberg, and Forbes. Ioannis has been shortlisted for the Future Thinker Awards of Thinkers 50. Ioannis will be exploring findings from the Great Recession, and he'll be revealing today the critical role of investments, innovation, and stakeholder relations during this time of crisis. So we've got one hell of an interesting show on today. I'd like to thank the panelists for joining, and I will be handing over to them. Just before I go, I'd like to say to my audience, I'm not going to be here to conclude the show. So I'm going to be saying goodbye today, but I'd like to thank you for joining once again. Thanks. And that's to both our YouTube audience and our Facebook audience. Thank you very much. Over to the Singular team. Thanks, guys.
Thanks, Mort. That's appreciated. Welcome, everybody. And Aline, if you managed to, or I don't know if you managed to Already load up the presentation. Excellent. Okay, guys. Well, welcome everybody, and thanks again for connecting to this webinar that we do sort of like either weekly or every second week. Today's conversation has been, how it's been already, let's say, mentioned by Maurice, is going to be especially, I mean, we'll follow the usual structure, which is basically, if you followed a few of the previous webinars, it's basically we're going, we're touching basing, firstly on the virus and the healthcare situation, specifically in South Africa. Then we talk about the economy and the policy making, and then finally we get into more sort of what businesses can do about it. Yeah. So Annelien, if you go to the next page, so that we get started.
Okay. There you go.
You can put it in full screen, and then we can get directly to page 2. Previous page.
There we go.
Super. Just a quick one on why does Singular do this? I mean, first of all, let's say our objective, and I hope we keep on sort of fulfilling it in these webinars and the documents that we share on LinkedIn every Friday, is very much fourfold. Number one, we hope to provide a level-headed source of input to inform leaders during this time of crisis. Number two, we try and be as practical as we possibly can. So this is about you, your businesses, and helping decision makers make a decision in a time of where time is a scarce resource and actions are required to be taken fast. Thirdly, we are very, very, let's say, honest and happy to be transparent about the many unknowns or known unknowns that are present out there in this phase, both when it comes to the healthcare situation, the economy, and obviously the business implications. So we'll always say whatever we know, we don't know. And fourthly, we're more than happy to share our learnings from our, let's say, global expertise as a management consulting company to give you as many as possible sort of framework and input and information that will get you to hopefully make the best possible decision in this phase. Okay, Annelien, if you don't mind moving forward. As I said, the structure is threefold. First, let's sort of double click on where South Africa is today. We always provide an update on this. South Africa is, so there's good news. There's some good news. South Africa is still tracking in line with Australia and South Korea, which are the best in class when it comes to limiting the number of fatalities in this sort of tragic time. Of course, when it comes to South Africa, it's earlier days for sure than Australia and certainly than South Korea. But I think there is a good, let's say, a good positive sign so far. So if you think about what are the deaths per million people right now in South Africa, they're about 5.2. That in comparison to Italy's 205 and South Korea's 3.5. And the global average is about 72. So overall, I think good news. Some of the reasons why that is are clearly still unknown, but overall good news so far. Okay. What is also good news is that the fatalities have been far less than initially predicted prior to the lockdown. So that's another good news. To what extent? Roughly about 15% of the deaths that were forecasted actually happened, which again, it's nothing to take away from the tragedy and the tragicness of the situation. But I think we can be happy to see that so far the measures taken were actually taken on the basis of a much higher forecast. If we need to put those deaths into perspective, those fatalities into perspective vis-a-vis other tragic sources of deaths like HIV in South Africa, like HIV and TB, if we continue, let's say, if based on the current forecast, we could end up at roughly anywhere between a third and an equivalent number of fatalities vis-a-vis HIV and TB, for instance, in 2018. This is to give the order of magnitude of the tragedy. So obviously what we ask ourselves is, can this be taken by government as, if you want, a reason to if you want, lift some of the restrictions and potentially speed up some of the opening, especially in view and looking at what we'll learn and what we keep on learning in the economy chapter of this webinar. And the third consideration is that, as we made already in the past, and we like to keep on tracking this graph, which is basically on the y-axis, you see the confidence of the results. What is the proxy we use for confidence of the results? This is the cumulative number of tests per 1,000 people. So in other words, are you testing enough? And then on the x-axis, you have the infection rate. So what are the percentage positive on the tests that you're actually performing? What we know for sure is that, with the very few exceptions, most countries start in the bottom left quadrant, and then they move to the right. They drift to the right, in the sense that as they increase testing, obviously they start also becoming better at identifying hotspots. The rate of positivity increases. What changes a lot is, of course, if that goes, let's call it the Norway way. So in other words, there is only a slight increase in positivity as we get more confidence in the results because we test more. And for instance, the Turkey or UK direction, where we had a massive increase in percentage positive as we increased the number of tests. Now, this last week, or 2 weeks ago rather, looked better than this week for South Africa, in the sense that South Africa seems to be drifting for now more towards the sort of United Kingdom and Turkey direction. If you look at where South Africa is vis-a-vis where it was on the 23rd of April, but it's still early days because the numbers of tests per 1,000 are still too low to take a conclusive, to make any conclusive statements on this. Okay. Now, one obviously clear, let's say, the elephant in the room, obviously, is the Western Cape. In the South African case, so the Western Cape in South Africa is a little bit of the Lombardy and the Hubei for Italy and China, respectively. What we observe in the Western, in terms of becoming a hotspot, when it comes to the Western Cape, I think what's particularly interesting is to see the number of new daily cases vis-a-vis the number of new daily tests. And here, what's slowly but surely becoming apparent is that there potentially is a shortage of tests. Now, the question is, and here it's more of a open question for us to all think about solutions, especially how to get the private sector involved to think about solutions. How do we fill this gap? Because as the cases are increasing, the tests are not increasing at the same speed as you can see on the graph. And in particular, why is this gap? Is it a matter of shortage of proprietary test materials which come from abroad? Is it a matter of the capacity to process the tests at a lab, let's say, laboratory level? Is it a mix of the two? Can we incentivize local production in some ways to speed up this the filling of this gap? Yeah, this is very much of an observation with an open question. When it comes to, as we all know, and we've just spoken about the Western Cape, we all know the virus typically moves and evolves in clusters. So the spread becomes exponential in a relatively small space and in a relatively concentrated area in the countries where it spreads. If you look at how this is happening, I mean, in China, we have the most extreme case, 98% of the deaths in only 5% of where only 5% of the population lives or lived. You obviously observe a very similar situation in the US, although not as extreme, where you have 31% of the deaths in New York and only 3% of the population in New York, and a similar situation in Italy. So the ratio can go as far as 3 to 20 times the concentration of death vis-a-vis the concentration of population. And of course, we're starting to see a similar effect in the Western Cape, where we have roughly 10% of South African population, but 55% of the fatalities so far. What does this, I mean, if you think about what does this tell us and what can this sort of lead us to think about, is certainly a differentiated approach by region, if not by city or metropolitan area or province, because we don't have to kill the economy at a broad level when we have a very localized issue, or mostly a localized issue. And on the other hand, we can't, I mean, the same obviously holds true all the way around as well. Now, in the next page, we see that South Africans' cases have actually increased. They've doubled in the past week, from 600 cases per day to roughly around about 1,200. And this needs, of course, I mean, we need to acknowledge this, and we need to adapt the modeling accordingly. And what that means is that the fatalities by the end of June, if the curve continues as we foresee it, could range between 2,000 and 5,000. And the critical bed capacity, which we always said was not going to be an issue at the speed the trajectory was going, could actually become an issue. So we could see around about 20% of the ICU bed capacity overutilization, which you see in the worst case scenario, of course, not in the base case or in the best case. But this obviously should function as a warning sign that this is an area where we need to start sort of taking potentially corrective and preemptive measures. Okay, so if we move into the second part, so we had a sort of a chance to be updated on the virus and the healthcare situation. Now let's move on to the economy, which is obviously the most direct, where we see the biggest and most direct impact. As you know by now, having followed us probably over the last few weeks, we always sort of present and update 3 scenarios. Now, obviously, these 3 scenarios have very many variables at play. One variable at play is obviously the lockdown. The lockdown causes a supply constraint, as we all know, which, needless to say, limits the output, the GDP output, the production in country. There is obviously attached to this also a fiscal and a monetary response. I mean, we were glad to see a further cut, what was it, yesterday, I believe, by the Reserve Bank on the repo rate. And obviously that will be cut further if, and especially when the situation gets towards a worst case. And then, of course, you have a global effect, which is the more lockdown type scenarios unfold, or the longer they are, and the more consumers' confidence go down and business confidence goes down because of a long lockdown, which had consequences on the amount of investments that businesses make, the amount of employments, and so on and so forth, the more, of course, this comes back with a vengeance on the demand. So this, if you take the interplay of all these variables, we create a best case, a base case, and a worst case. If we look at the next page, we can see, and this is more of a, let's say, reminder, because there's not too much new in this other than a slight adjustment in the numbers vis-a-vis 2 weeks ago. But basically, on a broad level, we see obviously a very dire situation for the economy. That's not news, unfortunately. A contraction that we expect anywhere between 10% and 16% in 2021. In 2020 vis-a-vis 2019. That obviously is no major surprise, but it's certainly a scenario we need to prepare ourselves to survive in. Yeah. Okay. Now, I would love to now pass on to Johannes for the next section of the presentation, and to try and sort of really draw some learnings from what we believe is the best possible place to take some learnings from, which is the Great Depression. The Great Recession, so the post global financial crisis. And he's done a hell of a lot of studies on our companies have reacted post financial crisis, and what constituted sort of the winning ingredients of those companies. And then I'll come back and sort of try and wrap it up into the framework that we typically go through and that we keep on building on, so that we can give you with some sort of reference frame to think about your business. Yanis, please, over to you, and thanks a lot for joining us. It's a pleasure for all of us and our listeners.
Great. Thank you very much for having me, Lorenzo. It's a true pleasure to be here with you today. So what I would like to do in the next 10 or 15 minutes, I would like to share with you some of the work that I did where we studied how was it that companies in the US reacted during the Great Recession, and importantly, what can we learn from that period or from that economic meltdown that may potentially be useful for the types of conditions and circumstances that companies all over the world are going to face during and of course after the COVID-19 crisis. So we do know from a lot of academic research that periods of major economic crisis do have some common characteristics. For instance, there is significantly greater uncertainty. Often these kinds of crises propel governments and regulators to think about policy and regulation. There is higher cost of capital, or as it happens in the current crisis as well, tightened access to credit. Of course, major disruptions into the global supply chains. And sometimes, of course, you can see the wiping out of entire industries. If you think about the hospitality industry, if you think about the airlines industry and so on, we have not only a reduction, but in fact a collapse in aggregate demand. Now, that's not to say that the Great Recession, of course, is exactly the same as what we're going through now. I think a big difference there is that the Great Recession was caused by reasons within the system. In other words, the problems with the subprime mortgage markets and so on. It started essentially as a financial crisis. Clearly, in the COVID-19 crisis, we have what we would call an exogenous factor hitting the world economy. In other words, the virus, and therefore we see a more coordinated, if you like, and a more trustworthy, perhaps, and a more immediate and timely response by global institutions, governments, and other bodies as well. Now, these periods of economic meltdowns do have severe implications for companies. And that's why these are often the times that, well, of course, not only existential threats, but this is also the time when companies have to, in a sense, rethink their corporate strategies, not only to maintain survival during the crisis itself, but keeping an eye also to the competitiveness of the business, both during as well as after the crisis. So the big question, therefore, is if we look at the US and the Great Recession of 07 and 09, what did companies do? And how did they arrange or rearrange perhaps their strategies in order to survive and then remain competitive in the long run? Well, one thing to know and to keep in mind is that a company's ability, right, to remain competitive will critically depend on its ability to reconfigure, to readjust its strategic resources. So one key takeaway is that during a crisis, it's very important not to look at our resources, whether it's human capital, whether it's financial capital, and so on, in isolation, but rather to see them as a portfolio of resources, as a portfolio of investments. And that's important because in a crisis, right, all this uncertainty and the broader economic meltdown, what do they result in? Well, they result in a situation where you might need to cut some of these investments. Some of your existing investments may potentially become more risky. And the organization often goes into a survival short-term mode, often perhaps forgetting or neglecting bigger issues, long-term issues, strategic issues, or even the authenticity, if you like, or at least the desire to stay true to the purpose and the mission of the organization. So what did we find when we asked the question of how did US companies respond to the crisis? If we could go to the next slide, please. So the major finding here is that companies, by looking at their resource base as a portfolio, both saved and invested their way out of a crisis. And this goes back to, in fact, the CEO of Intel, who at the time of the Great Recession said, quote, "You cannot save your way out of a recession. You have to invest your way out." We look at our activities in pretty much the same way. You cannot just do them in good times and then just forget about them in bad times. So that was the idea. As we were exploring the implications of the crisis, we asked, well, what did they save and what did they invest? In other words, how did they contract and how did companies expand during the crisis? So what we found is, as you can see on the left-hand side of the slide that you have in front of you, is that the companies in the US followed what we would call a two-pronged approach. In other words, to deal at the time with liquidity, they cut back on investments in tangible resources. And as we know, of course, they laid off people. But the surprising finding is that what did they do with that liquidity? Well, essentially what they did was maintain two critical intangible assets. One of them is innovation capability, and the second is stakeholder relationships, relationships that have to do with local communities, NGOs, governments, their employees, and so on. So the baseline finding is that they had a two-pronged approach where they diminished investment in tangible assets and laid off employees, whereas they used that liquidity to maintain their investments in innovation capability and stakeholder relationships. Now, why, you might ask, why did they choose to rearrange their portfolio in this particular way? And this is precisely where we go down into the mechanisms, and these are the types of learnings that we can transfer to other crises as well. So there were three interrelated set of factors that helped us understand why is it the case that they invested in intangible assets. The basic idea is that intangible assets, your relationships, the value of your reputation, the value of your integrity as a business is much more valuable when the going gets rough. When the going gets rough is exactly when people wait to see and observe if you have been true to your commitments and to the big words that you were saying during the good times. So if we dig deeper a bit into these intangible assets, especially if we think about innovation capability and stakeholder relationships, what we found was that there were at least three mechanisms that explain why companies would want to maintain their intangible assets. First of all, is that these kinds of investments allow for a company to become more efficient and more innovative. And we know for research, if you invest in innovation capability and stakeholder relationships, for instance, you're much more likely to find novel ways to become leaner, to become more efficient. And you can imagine how valuable that can be during periods of crisis. Investments in innovation capability can also allow you to experiment and to explore during the crisis. And of course, investments in stakeholder relationships might very well spark much needed innovation during this time. Second of all is this whole idea of adaptation to shifting needs, demands, and expectations. If we know anything from the COVID-19 crisis, is that we are going to see behavioral changes, perhaps on behalf of investors, perhaps on behalf of our customers, our consumers. So if you are a company that invests in those intangible assets, invest in those relationships that allow you to get timely, accurate, and more trustworthy feedback, that means you have higher quality information in your decision-making process, and therefore much more likely to make better decisions in the times of crisis and essentially better adjust because you have more information compared to companies that perhaps cut those investments or diminish those investments or retract in a period of crisis. And the third reason, broadly defined, it has to do with organizational resilience. We know from a lot of work that investment in intangible assets like innovation capability and stakeholder relationship is a strong signal to all stakeholders about what is important for you as a business, what is important for you in terms of your competitive advantage, but also it helps you enhance, or at the very least maintain, things like your brand, your reputation, your social license to do business, and the trustworthiness of the business in itself. So if you put all these three mechanisms together, in other words, the efficiency and innovation, the ability to adapt, and the ability to be resilient, we found that those are essentially the sets of factors that really highlight why is it important in times of crisis to steer your resources as a portfolio and try to adjust them in this particular way. And the final component, and I'll stop there, and happy to take more questions and your comments in the Q&A. I think the last component we checked was, well, what happened in the recovery period? Did these intangible assets and these investments, in fact, pay off after the crisis was done? And what you can see in the lower right-hand side of your screen is that companies that did not reduce R&D did significantly better. Companies that did not reduce your investments in stakeholders or social responsibility, they did better. But in fact, the companies that did best in the recovery period in 2010 and 11 were the companies that were able to maintain, in other words, those that did not cut their investments in both innovation capability and stakeholder relationships. So I'll conclude by saying that we call them intangible assets, stakeholder relationships, and so on. But the idea here is that the current crisis is really a test about this broader discussion that we have about stakeholder capitalism, and the idea that the business, in order to survive and thrive in the long run, it has to pay attention to all of its stakeholders and not just its stakeholders, to be true to its purpose and to its mission, and that doing so can actually pay off both during and as well as after the crisis. And in fact, not only at the corporate level, we already have preliminary evidence, right, from a number of companies out there, including BlackRock, that show us that what we call ESG funds, or socially responsible funds, have been actually better positioned to weather the storm, in other words, the COVID-19 crisis, compared to traditional funds. And one more important thing to note is that this crisis is fundamentally different compared to the Great Recession, because truth of the matter is the world is watching in terms of what companies are doing to respond to the crisis. The world is watching with expectations. How does your company or your organization, in this time of crisis, when we're all in this together, what do you do to help ameliorate a social need or an urgent social need that has sprung up because of the crisis? And already you see that not only, of course, in the US, but also globally, there are organizations that are monitoring corporate responses, and they're very transparent. In other words, they publish their findings about how companies respond. So I would conclude by saying that based on what we learned from the Great Recession, but based also on what we are learning, both in the healthcare domain, but also in the broader economic domain about the COVID-19 crisis, as a CEO or as an executive or someone that runs an organization, I think there's 3 or 4 questions that one should keep in mind as you decide how to run your business during this time. I think the first of all is, the first question is, what can I do to ensure that my company's purpose, my mission, my vision, if you want to call it that way, guides and inspires, and it is actually fully consistent with my company's both short-term and long-term objectives. Second, how can my company's resources and capabilities, what I know as a business to do best compared to anyone else, how can I utilize them for improving the collective well-being, for addressing urgent social needs? And that's the expectations social expectations I was talking about earlier. Third, what can my company do, especially for those of you that might be working in larger organizations, what can my company do to shield my employees, my supply chain partners, my customers, in general, my stakeholders, through this crisis, but of course also in the long run. And finally, it's critical for executives, I think, to continuously think about how to ensure that the survival mode that will inevitably kick in, or the panic mode that will inevitably kick in, does not overtake the entire decision-making of the organization. In other words, a fixation to protect profits today at the expense of hijacking, literally hijacking these very difficult to build long-term relationships and long-term assets like trust and like integrity. So I'll put a full stop there. Thank you very much. And I really look forward to your questions as well.
Yanis, thanks a lot. This was great, very insightful as always. Thank you so much. And I'm sure we'll be able to get a little bit more of you in the Q&A as well. So maybe just to sort of launch, if you want, or create the launching pad for the Q&A, we'd like to sort of usually present let's say the framework that we use these days with companies that are thinking about how to tackle best the current situation. And there's very much 3 steps. And I would love some of the questions to really bring to the table some of the difficulties that you're facing. You can frame it in one of these 2 steps. You can frame it however you wish. But I would love to really give you three ideas of things that we see critical in this phase. The first one is that this shock, external shock, as Janis said, is obviously dynamically impacting the external environment and therefore our system. So you need to have this dynamic shock assessment, which typically means assessment of the economic implication, the regulatory implication, the way the consumer behavior is likely to change or is shifting partially or radically. And obviously there's a geopolitical dimension to this. If you think about what we're reading about the US and China relationship, especially in the last 24, 48 hours, but obviously that was beginning a lot earlier than prior to COVID. But I think this will be part of our business life, of our life and business life for a while to come. So this is the sort of step 1. And here the mistake, obviously, that one could make is to create for yourself one sort of scenario, one too fixed sort of idea or scenario or criteria vis-a-vis dedicating some part of the organization to the continuous monitoring and the continuous adaptation as you monitor some of the leading indicators that are important for your business. The second step is the strategy adaptation. Now here it's important that we think on the basis of not only 2 dimensions. One dimension is where do we think we are in the cycle of the crisis I'm talking about. So are we in the fall, and how do we define the beginning and the end of the fall? Are we in the turnaround phase? And the same question applies. Are we in the bounce back? Yeah. And then the second dimension is what can we realistically afford to do? So in other words, how conservative have we been in the 10-year prior to the crisis? And obviously part of it is skills, part of it is preparation, part of it is just chance and or industry dynamics. But basically, what is the level of distress of our financial health as a business? And obviously the way we can capture, the way we shift mitigating the negative effects to rather taking some of the opportunities depends very heavily on these 2 axes. So on where we are in the fall, turnaround and bounce back, and how do we see ourselves in terms of financial health and ability to get potentially finding elsewhere. Now the third step, and here the mistake we see in this step number 2 is very much looking at things only from with a one-size-fits-all sort of recipe. Because we all know that sort of online and digitization trends will speed up, or we all have a thesis that in some shape or form goes along those lines. Therefore, we need to do X, Y, and Z, A, B, C, and D. In some cases, there's nothing you can do about that because you need to fix and plunge the hole somewhere else in the business a lot earlier than when you can think about that. In some other cases, on the other hand, you can move rather quickly. So you need to really look at the situation with the two dimensions in mind. And then linking back to what Yanis already said about the resilience, I mean, the building blocks of, so once you've identified how you adapt your strategy, and once you've created your SWOT teams, that's the way we call it, and that's how we presented it also in the last few weeks. And once you define how those SWOT teams work with the organization to bring forward some of the projects, some of the initiatives that will let's say, implement this strategy adaptation that we just spoke about, whether it's hoarding cash, whether it's adapting the business model, whether it's pivoting into a new norm that you've already identified for the bounce back. There's really three ingredients that we see need to form part of this, and this links back to very much to what Yanis just said. One is being extremely responsive. Now, we are in extremely uncertain times and things are volatile. You need to be responsive. Catching short-term opportunities is perfectly okay. Second is being adaptive. So you need to have the long-term also adaptation of that comes from the long-term trends in mind, just like a biological system adapts over time. And thirdly, you need to really think in ecosystems. You cannot become a digital expert tomorrow just because you realize digital is going to become important in my business, whatever that business is. And so you need to think in ecosystem. You need to broaden your ecosystem and leverage other parties' capabilities, other companies' capabilities, and learn them over time rather than reinventing the wheel and certainly doing it all at the same time. Now, I will leave you with this in terms of thinking. Obviously, the report that we publish, we will publish it tonight on LinkedIn on our Singular page, is, as you know, much longer than what we get to present and much more detail, because our objective is very much to help you and your business in a as practical way as we possibly can. But we would love to use the time now to really hear your questions and your comments and be able to tap into the expertise that lies around the table. Okay, so let me look at a couple of the questions, and then based on the type of question, we can see who takes it. Hi, Lorenzo. What is your view on the likelihood of an extended period of deflation in South Africa? Something to worry about. So I'm happy to give it a first step, and then Yanis would love your view on this as well. I mean, my personal view, and we could get into an extremely complex discussion here. My personal view is that there is a very decent chance to get into a deflationary period at first. And then depending on how much money printing happens at a global level, so here I'm thinking about at a global level, there could be an inflationary period that comes after that. In South Africa specifically, I do not see necessarily the inflationary part, so the second part, but I certainly see potentially the deflationary part. That's my perspective. It's a very long, let's say, and complex topic, so I can't go too much into the details of the how and whys, but Yanis, would be great maybe to also get your perspective from up in London.
I think it's a tough one, and I think that is the big question, right? Because we are seeing all these massive, unprecedented stimulus packages around the world, an explosion in the debt levels of all the major economies, and there's a big question about, will this be inflationary down the line? Now, clearly, there's other trends that we need to account here. For instance, what's going to happen with the oil price? How quick or how slow will the broader energy transition be? And I think the answer to how bad or how the inflation is going to be will also depend on how quickly the real economy kickstarts as the lockdown as the lockdown wears off. So I don't think that anyone has a crystal ball to do that. But I would say that in order to get to the answer to that question, it's very important to see what's happening in the energy markets and how quickly we see real GDP picking up after the crisis. My only concern on that is that, unfortunately, it's very likely that we're going to see national governments starting to play a very zero-sum nationalistic game on the global scene, with more implications about global trade and international transactions, which clearly cannot help with kickstarting the economy. If anything, is going to delay us, arguably, even more from getting to the previous levels of economic activity and therefore avoiding inflation. So if anything, I would monitor those indicators, if you like, to try to understand what's going to happen on the inflation side. Yeah,
completely agree. Yanis, there's another question for you from an industrial engineering graduate from WITS. Has there been any investigation into companies' responses in developing countries? So in other words, can we draw any parallels between these companies based on what you've presented in the US?
I'll answer that. And I think, Lorenzo, there's another one earlier up about CEO remuneration and employee layoffs from Marius.
From Marius, yes, I missed that.
Yes,
please.
So I think on the last part, I think these mechanisms that I just described, they're not context specific. Companies in developing markets as well will still need to understand the changing demands and expectations of their customers. They still have supply chains that are being disrupted, and therefore it is important, especially if you're a large company in this particular context, to take into account of the impact of the crisis to your entire supply chain. So I do not want you to go away thinking that, oh, these are the mechanisms that you work in the US. Clearly, this generalized, because I would assume that every company around the world will want to be more efficient during a crisis. That's not the US phenomenon, and not only developed, but of course developing, right? And I think that to the extent that we might have a difference in institutions between the developed and the developing world, I think there is not a smaller, but in fact an even bigger role of companies to step up their efforts in this time where, in some cases, institutions might be relatively less effective. So I think that, and by the way, it does not, they don't need not be large companies, small companies as well. They can do a lot about their own customers. They can do a lot about their own employees as well. And that, if I could answer the other question as well, because these are linked, I think the idea that, so first of all, we need to, when we start talking about employee layoffs, we need to understand that companies have options these days, right? It's not just about firing or not firing anyone. We have furlough schemes that the government pays some part of their salary. We can, some companies might give you, reduce your hours without necessarily firing you. And sometimes we can even do, companies do redeployment. Clearly there are sectors like supermarkets, retail, and deliveries and so on that actually have an increased demand for employees. We even did that at the London Business School with some of the people we have on the staff. In other words, you can redeploy them. Right. And by the way, if you want to see a recent example, you should see how Airbnb decided to fire some of their employees. It's by now a kind of a notorious letter that the CEO wrote, but he said, and this is an interesting attitude, right? He said, we want to be the best an employer in the world, and therefore the employees that had to be laid off, they were given a whole year of health insurance. They were given the laptop from the company that they were using. They even created, I think, a career center for them to try to help them find their next job. So it's not as binary as we think about it. And finally, I do think that we are going to start looking at not just the environmental issues that we've been focused on, but in fact the social issues. And yes, of course, we're going to revive those discussions about executive compensation vis-a-vis employee layoffs, because what we've seen in this crisis is that some practices, the moment they become transparent, are simply considered unacceptable. Not only about remuneration, I'll give you another example. Adidas in Germany, right, that did, I think, something like 2 billion euros profit last year or something to that effect, right? They were the first ones to try to not pay their rents for their shops in Germany. Now, the moment this came out, they were like, are you joking? Like you're going to screw over all these small holders, right? So that have from which you're renting, given how much profits you did last year. I think that we are developing as a society, I think, a sensitivity and awareness, and perhaps generating accountability about all these actions that simply do not feel right. And companies, that's what I was saying during my presentation, I think this is a crisis in which the world is watching, and the world is very closely watching. If you see, Financial Times, Just Capital, they literally have a name and shame section to talk about these kinds of events. And clearly on the remuneration part, by the way, it was a big discussion about Disney, right? That if you compared the compensation of the CEO versus the fact that so many people were fired from Disney, and that again sparked the discussion. And I do think we're going to, and I'll finish with that. I think it's going to be look different because now investors are looking at this as a risk. It's a risk to your social license to operate. You open up yourself for further employee action, perhaps consumer boycotts, perhaps loss of reputation and brand, and so on. So if anything, I would also expect the investors to become more sensitive about these issues and therefore reignite that discussion, for sure.
Yeah, I couldn't agree more, Yanis. And I think both of us are quite passionate about the impact investing and the sort of ESG aspect to this. So I'm very pleased to see that the sensitivity to these themes is much higher now, or at least to my perception, than it was, for instance, in the 2008 or post-2008 crisis. There's actually a question related to this from Mike. Compared to how most governments responded to the COVID-19 crisis, post the 2008 financial crisis, are governments doing enough to provide relief to ensure a return in economic stability? I mean, here, let's say, what we are certainly observing is that the whole ammunition set has been shot much faster in this particular environment, and the ammunition set has been actually broadened. So I think if we are to compare, let's put it this way, if the COVID war was a war to be fought in the same way as the financial crisis, I think our response would seem to be adequate to the circumstances. Now, the problem, and that's, I think, the big question, is, are we fighting it? Should we fight it in exactly the right way? So the problem is that the supply shock and the effect of something like COVID to consumer sentiment is unprecedented to a big extent. And therefore, it's unclear, at least unclear to me, whether the weaponry that has been used is enough, the type of weaponry that has been used is enough to actually push the economy back to stability. But in terms of magnitude of the reaction, of the traditional reaction, let's call it, so monetary and fiscal policy, I think certainly it's been incredibly large and certainly larger than it has in relative terms to the 2008 crisis. I don't know, Yanis, what do you think about it?
Yeah, no, I agree with you. The speed of the reaction, the magnitude of the reaction, because I think if you look at the vast majority of economists around the world, there is no discussion about what the remedy is. And it's definitely maintain the liquidity, make sure that, you maintain employment as far as possible, because those are essentially some of the preconditions for the kickstarting of the economy. To be fair, though, what really worries me in how governments have responded, especially if you see the US government or even the UK government, what worries me is as follows. First of all, is the fact that these are massive stimulus packages and they need to have democratic accountability and checks and balances in terms of how this money is spent And I think we don't see that as much as we should. Look at what's happening in the US. Look at what's happening, for instance, in the UK, where Parliament did not meet for so long. So some populist governments might see this as a carte blanche to start spending as they see fit. And that's dangerous because, for instance, if that stimulus money is used instead of building green infrastructure, is used to subsidize even more or prolong the decline of industries like the coal industry and so on, I think we're only put of an even greater disaster down the road in the form of climate change. And the second one that is very important to keep in mind is that during the crisis, governments, yes, of course, they took a number of economic measures, but also they took an unprecedented number of surveillance measures, right? In terms of how they're monitoring us, where we go, where we do, how much we're outside, and so on. So it is critical not only to keep an eye on the government's economic policies, but an eye on the protection of our personal data and our personal freedoms, and the big brother effect that has taken over in a very dramatic way in some countries. So I think those are interrelated when it comes to government responses to the crisis.
Possibly have time for one last question. Marius asks, can countries afford more austerity following the COVID-19 pandemic, or are we leaning towards debt default risk? And my perspective on this is that, I really see this going one of three ways. I mean, as you said, one is austerity in the form of typically fiscal austerity in some shape or form. One is obviously default, country default and company default, defaulting on that. And then the third one, which actually I'm leaning more towards, is inflation. Effectively, I believe it's going to take so let's say the ideal scenario would be that the reaction is enough so that the spending starts, the economy restarts, and then slowly but surely you can increase the austerity, which, by the way, did not really happen after 2008. Certainly not, neither on the monetary side on a broad level, broadly speaking, nor on the fiscal policy side. So I doubt this will be the case this time. I just don't see that happening. I think we will see some defaults. I think some countries will potentially, certainly some companies, but potentially even some countries will be in a position to default, especially the ones that have in relative terms more dollar denominated or foreign currency denominated debt. I hope and think, not that doesn't have any negative consequences, don't get me wrong, but that countries will inflate their way out of the debt to some extent, at least the ones that can do so, because they have the confidence from the rest of the world and therefore the ability to print money, such as the US. And that's why I mentioned a deflationary initial period and then an inflationary. But we are, just to be clear, we are in the known unknowns space. So I don't want you to take any of this as a gamble. Don't start betting on inflation on the market on the basis of this, please. Yanis, do you have any final thoughts on this one, or shall we close it off?
No, I agree with you. I absolutely agree with you. I think that one interesting idea that I'll put on the table, and I was reading about this as well recently, is the idea of potentially replacing debt with equity, right? And thus aligning more long-term incentives, even from and I mean equity on behalf of the government, right? Clearly, that's a sensitive issue. It has implications about what we think about capitalism, if that's the case, right? But I think it's one solution on the table that might be an alternative, if you like, to excessive debt and then default risks down the line. Whereas, if governments take equity stakes and then the economy recovers, then it might also be beneficial for the taxpayer at the end of the day as an alternative.
Super. Guys, thanks a lot for all of our listeners, and we hope it's been of some use and relief. Thanks a lot to Yanis for joining and for this incredibly valuable contribution and learnings from the last recession. And I wish everybody thanks of course to the Singular team that made this possible. And
from Schindler's, thank you very much.
And Schindler's, thanks a lot, and thanks COBRA. And I wish everybody a great weekend ahead.
Thanks, everyone.